Hey guys, Phil here from Quantum Trading, and I just got off a call with a client who's now a partner, and I felt like making a video really about what we do and something that became very clear in that conversation with the client. He was a client that, or is a client that we're developing a strategy for him specifically in order to pass PropFi challenges. If you know what a PropFi firm is or don't, it doesn't really matter. But while I was talking with him about the profits of that strategy, which by the way are really good, I thought about, okay, what is the difference between the mindset and the perspective of institutional traders and retail traders? And that is something that we have been obviously thinking about and working on for a long time. Uh, if you know the history, we're at Quantum Trading. For the past 2 years, we had have a hedge fund managing up to $5 million in crypto and in other assets. And from the beginning, we were developing algorithmic trading strategies and um, theories that we were developing, proving, and then once we proved them to be valid, we were trading them. And the one thing that we have learned out of necessity, really, and it did cost us quite a bit to get there, but the difference was that we stopped thinking, I would say, like retail traders, right? We stopped thinking about instant profits, huge trades, over leveraged trades, which we used to do a while ago. We used to, get like 300, 500% trades on crypto and things like that. And moving from there into an approach where it's like, okay, how can we make sure that we're consistent with the low volatility in our profits all the time, constantly? Because that is really how institutions make money, right? And have it in a way where I don't have to wait 10 years in order to see some results because I'm undercapitalized or I'm not trading with enough money, which is the problem for most retail traders. Right, so essentially the main problem from retail traders, and that is why then they have bad habits or take risky decisions or non-calculated decisions, is because they need to make up for the lack of capital that they have in order to trade like institutional traders. So that is a deficit, right? It's a difference between retail traders and institutional traders, and institutional traders have an advantage right away off the gate because they can tolerate a bigger risk. They don't need the profits immediately. They don't need to compound the way retail traders need to in order to sustain a very aggressive trajectory of their portfolio. So eventually it makes sense for them to make percentages off of their portfolio that they can live off of. When you trade $1,000, $2,000, and you make 10% a month off of that, which for institutional traders would be amazing, for you it's you can barely go to dinner for that. So obviously you cannot sustain, and because of that you are exposed to bigger risk, or you need to expose yourself to bigger risk. So immediately that's a disadvantage. Then the second one is perspective, which means that as an institutional trader, rather than zooming into a market or what a pair or time frame or coin or whatever you're trading, index, instead of just doing that and looking at a 1 minute time frame and trying to get the perfect entries and exits all day, and you'll see that over a long period of time there will be situations, most likely there will be situations that will just eradicate all your profits, and you'll be in the cycle of trying to figure out why that happened, make back some of the losses, maybe get profits again, and then cycle that back to the institutional traders, essentially, right? Whereas the mindset change, and also for us the change was then, rather to try and force to make one strategy perfect, right, that many people try to do, accept the weaknesses of a strategy and utilize that to our advantage. And the key takeaway there is taking, not forcing anything onto the market, taking the market as a fact, and then seeing how we can leverage and utilize what's happening in the market for our benefit, and have that as a win-win scenario rather than fighting it, being, a part of it and helping it, right? And I'll get into more detail about that later on, which eventually gives you an idea how the market works. And when we talk about market makers and stuff like that, where till now for many people it's some fairy tale dust, like who's a market maker, they're this, I don't know, underground people or something. It's not really the case. It's actually specific people, which I'll go over, but really having the perspective. So what we did with a different perspective, right? We accepted that every strategy has their weaknesses and said, okay, well, what are the weaknesses? Are we able to isolate those weaknesses? We were able to isolate those, but we weren't able to remove them from a strategy, which led us to the theory that, okay, well, in the market there will always be scenarios that will try and test your strategy in a way where it's not going to perform well. So having that as a fact, how can we take care of that, and how can we still end up on a profitable side? Well, that scenario, that is isolated, that's going to have a strategy lose, well, it doesn't mean that we cannot make a new strategy that trades exactly that scenario and profit off that scenario, right? So give you an example. You have a trend following strategy, right? So whenever a trend happens and it starts going either up or down, the strategy recognizes that and just enters into the trend. And you have a second strategy, that's a trend reversal strategy, meaning that strategy is trying to time the right time, basically, when the top or bottom of a trend is, and then go into the reversal of that trend. So those strategies by definition are opposite of each other, right? Which in technical terms, they're negatively correlated. So let's say you have two of those, and let's say you have two more strategies that are negatively correlated as well. So you have four strategies now, and all of them are negatively correlated, meaning that by definition, when one works, the other one doesn't, right? And when one doesn't work, the other one does work. So, and you put that into a bundle, right? What is the performance of that bundle? Is it more or less consistent than other strategies? Well, if you have a market situation and your favorite strategy is starting to lose money, starting to lose your profits, maybe you start going into losses. Well, now you have other strategy that is making profit over the same exact scenario. And now you would think, okay, well, does that mean that they're all just net zero? Well, they're not, because every single one of those strategies individually is profitable in the long term, right? The only problem in those strategies is those situations where they lose that amount of money, which are hedged essentially with the other strategies. So that was a paradigm shift that we had, rather than looking and forcing one strategy, having the perfect strategy. We took a step back, looked at it. Okay, well, what are we working with? What are the realistic facts, right, that we're looking at without any bias, or we're trying not to, and how can we work with that? And this was an approach that helped us raise a few $1 million and then trade them successfully too. And so that's number one. And then number two, and this is really the important part, and something that not many people tell you. In fact, I am sure that no one told you before, which is the absolute unfair advantage that institutions can have over you. Which is, I'm sure if you are a trader and you have been trading and you have traded more than 10 or 15 trades in your life, then you will know what I'm talking about, which is, when you have your stop losses and take profit levels and the price comes close to it, and sometimes it hits your level without the price being there. Sometimes the price goes there but it doesn't hit your level, right? And you blame liquidity for that's the reason why it didn't happen. Well, not really the case. Every single broker, every single terminal actually has a backend, which is called the back office. And that back office is the middleman and the connection between you and the actual broker. And that is literally every single terminal or every single platform you work with. The bigger platforms like in crypto, Binance and stuff, they just have their own, like they are the broker, right? And they are also the middleman, right? So that's the next level. But a great example for this are prop firms, right? So I don't know if you know what a prop firm is. I'll just explain it really quickly. What I just said at the beginning of the video, where people, retail traders have their first problem is that they're undercapitalized, right? So they need to take risks that would not be necessary if they had enough capital, and they would be able to trade better, right? So now there's prop firms, and the idea that they advertise for prop firms is that they give you a challenge, and if you pass that challenge for a fee, you enter the challenge for a fee. If you pass that challenge, then they give you a funded account of up to $500,000, $1 million, whatever it is, whatever the prop firm is, and you can trade that account, and you get 90% of the profits that you make on that account. Sounds great, right? Problem solved. Well, yes. There's two things, and there's two parts how a prop firm makes money. And I'm not judging anything as good or bad. This is just literally what the case is. And then once again, with our paradigm, this is a fact. How can we take advantage of that fact? How can we create something or work with it in a way where we have an unfair advantage compared to the market, right? So step one is they have the challenges, and the challenges have a fee. And what they do is they give you the challenge rules, right? And in those rules, literally how they make money is that in those rules they hide statistics, and those statistics are not clear to retail traders, and the challenge seems much easier than it actually is. And I have been talking to many prop firms, also one of the biggest ones, and essentially 99.5% of a big prop firm of the challenges taken are failed. 0.5% of challenges are passed, which is an insane number, and that is where they literally get their money off of. They're not really off of trading, but off of the prop firm challenges. And a good rule of thumb is, the better their marketing, the more, thinking about it realistically, the more people they're trying to advertise it to, and the lower the prices of the challenges, the more they benefit off of the profit off of the challenges. So they're not really a trading firm, they're a marketing firm, right? And their profit is the difference, the margin between the perceived stats of the challenge and the actual stats of the challenge, meaning that you have a maximum drawdown, you need to trade 3 months or something like that. Here I have a couple prop firms with their challenges. This one is actually, I've been looking at it, this is crazy. This prop firm, when you look at this challenge, it seems to be very, very easy. However, they have a trailing stop loss, and they have basically what they say is you need to make a profit goal, which is not that much. I think it's 6%. However, you need to, for 3 days or 3 weeks or something like that, you need to hold above that profit goal with the trailing stop loss, So it's like, okay, well, that shouldn't be that hard. Well, if you need to trade, what is the chance, statistics, what is the chance of going below that profit goal? If you actually write it down with pen and paper, you get to the point that, like 95% chance that you're gonna hit it at some point, And those are statistics that they don't advertise, but those are statistics that they make money off of. And if you look through this, like, these are insane rules that don't seem that clear, but like when you go through this, it's actually insane. Like there's basically a 0% chance that you ever get paid out or ever I think they evaluate you for 3 months even after you get the funded account. So they will basically never pay you out, and they make money off the challenges, right? So that's prop firm number one. That's part one on how they make money. Now part two is the even more interesting part that no one tells you about, which is that there's a backend on every single platform, right? And that platform, so let's say MetaTrader 5, they have a backend. It's called back office, and you need to get certified in order to go in there. And there's only so much you can talk about it, even me right now. But basically, you get into the backside of MetaTrader, and essentially through the backside, you see everything that a trader is doing. Number one. And then number two is the way the prop firms get funding is through a liquidity provider and a broker. So now you're the middleman between the broker, the liquidity provider, and the trader. And depending on how the trader's trading, their risk threshold, their profitability, you get a deal with the broker and the liquidity provider, and you basically deal that trader out like a casino, right? You're the one dealing the chips, and you get terms and fees with the broker based on that trader. And if you have 1,000, 2,000 traders, then you can manage, literally distribute risk like a bank does, right? And you essentially, a trader comes to you, they do the challenge, and when they do the challenge, you basically give them a loan, essentially, and then based on their risk threshold, you manage the loan and pay back the loan, and work with the broker. You can exchange traders with other brokers depending on risk thresholds. It's a whole different world. And so essentially, if you're in a prop firm and you pass a challenge and you don't fit their agenda, you don't fit their marketing angle, or you don't fit their current portfolio, what happens is they just make your life very hard, because they can. They increase your spreads, they hit your stop losses or don't hit your stop losses. Everything that you would say, that was a market maker, or the liquidity was horrible, or the liquidity was crazy, all of that is literally someone turning the dials on you. And if you are in agreement with the prop firm and you don't know how they make money, number one, and you don't know what they're looking for, are they looking for high volatility traders, are they looking for consistent traders? If you don't fit that category, they will make your life incredibly hard, and they will end up being the ones making money, right? And now the second part is that, let's say a prop firm has 100 traders or 1,000 traders. They see every single trade, every single order, everything about that trader, so they know exactly where the stop losses are, exactly where the tip profit levels are. So they can, with a 100% guarantee, they know that if the price hits this level, there's this many stop losses. This many stop losses hit in this time, and the price will go over here. And that they can just arbitrage it very, very easily. So whereas you are trying to guess where the liquidity pools are, where the supports and resistances are, where the orders are, where the order book is, they know exactly where the order book is. So when there's a trader, when there's a back-end trader, and he trades for the prop firm off of the data that the traders give them, if you're supposed to trade against that person, because we know that the market is a zero-sum game, someone needs to win in order that someone loses, you have no chance of beating that person, because he sees your cards, and he sees his own cards, and then he sees everyone else's cards as well. So it is not a fair game in any way, shape, or form. And it's not a fair game because of part 2 and part 1 as well, which is, first of all, they just make money off of the challenges, and they profit off of the fact that you haven't done a simulation of the statistics and saw that it's actually very, very improbable that you will pass a challenge. And then number 2, when you do pass the challenge, they either make the life hard for you so they don't have to pay you out, and if you do fit, by some miracle, if you do fit their agenda, then they use your data in order to counter trade you, or make 100% sure trades rather than having to guess about that. So this is what, when you say market maker, when you say these people are controlling the market, this is what it is, right? It's people that see all the cards, and you are either a pawn, or liquidity, or literally just a monthly fee for the challenges that you pay, right? So with this information, we were like, okay, how can we take advantage of that, right? So the point was to create the strategies, like we said at the beginning. We create the strategies and we put them into bundles. We distribute them in a way where no matter what happens in the market, there is some strategy that makes money off of that move, right? We bundle them together and we have consistent results. Then we don't go to random challenges. We go to a specific prop firm, or well, liquidity providers really, and say, hey, this is what we want to do. What is your agenda? What is your business plan? Can we work together? And they then give us a specific account or challenge specifically for our strategy that we will pass and go through, and then have exact rules and terms that we will work with the prop firm in order to take the work that we did, right, of creating those strategies, and leverage that with the largest multiplier possible, which is exactly what banks do, right? So we're taking the perspective of institutional traders, and we take our work, we multiply it, by 500x, whatever the challenge fee is to whatever the account is that you can trade with. And you do that in terms by striking a deal with the prop firm, right? You're not just someone that pays the challenge fees. You're someone that is going to help the prop firm to work towards their goal of, distributed risk or their desk dealing. You let them desk deal where both sides win, and with those accounts, then you will make your profits, right? And you will make 500x the profits that you would do otherwise. You're not undercapitalized. You don't have to do too much risk, right? And you know what the game is, and you are looking at it as an institutional trader, and rather than doing the guesswork, you have the information from the prop firm, right? So this was the approach that we started to take, even in the hedge fund, and even if people approach us, our clients that we create strategies for, right? And this was probably the biggest misunderstanding or the biggest difference that retail traders and institutional traders have, right? So we decided to create a community, a Discord, where we educate people about these exact things and how to create strategies, how to create approaches and mindsets in order to think like an institutional trader. Take a step back and have, instead of hoping and gambling, we take a step back, see all the facts of a strategy, say, okay, these are the times where the strategy does well, these are the times when it doesn't do well. In the times where it doesn't do well, what do we do? How do we fix that? Who can we approach in order to get the biggest leverage off of that strategy, and then work with that, right? So from starting to define a strategy to, either you don't have a strategy yet, or you do have a strategy and you want to perfect it, starting from there, over optimizing the strategy, making sure that it actually works, which is, probably 2 years of my life that went into that, making sure that the strategy works and, analyzing it the right way, to then helping you approach a prop firm not as a retail trader, not as their sheep that they make money off of, but as a partner, where you will go directly to the desk dealing office and tell them, okay, well, here's the deal, here's my strategy, are you interested or not, what are the exact terms that you give me? And then using that and leveraging your work that you did before in order to make consistent returns, where you don't have to risk too much, and trade with an account size that is justifiable for your work that you put in, which is everything from $100,000 to $1 million, depending on your risk and your volatility. So this is the reason why we created the Quantum Trading Discord, and this is what we will be going through basically every single day on calls. You will see us live do this, and then we will help you develop something similar where your mindset and your approach will turn into that of an institutional trader rather than a retail trader that's just getting milked and destroyed from all sides. So that's the goal of the Discord. That's the reason the Discord has been created. And feel free to take a look. And inside that Discord, I think that within a few days even, you will be very, very thankful that you came across it. So that's all I wanted to say, and yeah, I'll see you there.